Welcome back to the Global Ledger. I am Justin. In the last episode, we explored risk premiums. This is how markets decide what risk is worth, is what we talked about in that episode. But today, we're turning to one of the most powerful indicators in all of finance. It's the yield curve. And I call it the map, the market's map of future funding, future growth, and future liquidity. It's not just a chart. It is a structured spreadsheet of expectations, a reflection of balance sheet stress, and a proxy for future risk premiums. So most people think the yield curve predicts recessions, but the truth is deeper. It reveals how the financial system prices time, prices liquidity, and prices safety all at once. Let's get into it. What the yield curve really measures. Textbooks define the yield curve as a plot of treasury yields across different maturities, so different points of time. Technically true, but the real meaning is the yield curve expresses the price of funding over time, from all the way from overnight to 30 years. So each point reflects demand for safety, supply of collateral, expectations of future Fed policy, inflation expectations, what else? Global dollar demand, dealer balance sheet constraints, hedging pressure, I would say, and of course risk premiums. It's a compressed database of really the entire dollar system. So let's begin with talking about the short end, and I would call this the world of the Fed and funding markets. So the short end of the curve, 1 month to 2 years-ish, so is dominated by the Fed's policy rate, overnight repo, T-bill demand, liquidity conditions, swap spreads, dealer funding costs. This part of the curve is about cash-like assets. When short rates rise, funding becomes more expensive. Leverage shrinks. Let's say liquidity tightens. The risk premiums, like we talked about last time, they widen, and certainly valuations fall. So when short rates fall, however, funding becomes easier. It becomes the ability to buy and sell becomes easier. This is liquidity improves. Risk premiums they compress, and in turn valuations rise. So all this in motion on the short end, and so the long end, the part that we see all the time. There's a lot of action going on there as well. The long end, we're going to say 10 to 30 years. This is shaped by long-term inflation expectations, also long-term growth expectations, the demand for duration, hedging flows. And hedging flows, I want to say especially from pensions and insurers, which we'll do another episode on that. But that'd be cool to kind of see how that ties into everyday folks like us. So some other things that the 10 to 30 year is shaped by. Global sovereign demand for treasuries is another one. Geopolitical stress, clearly, in scarcity of long collateral. So the long end, I would say, is less about the Fed. And more about the future risk premium. So when the long end collapses in, say, yield, investors want duration. Growth expectations fall, inflation expectations fall, hedging demand rises. So global dollar shortage intensifies. But when it rises, risk appetite grows, inflation expectations rise, and global demand for safe assets start to weaken. We've heard this term many times. It's called the inverted yield curve. So what's the truth behind it? It's often described as market's expectation of a recession. True enough, but more precisely, inversion happens when short-term funding becomes restrictive relative to long-term growth in inflation expectations. So what this means is the Fed is above neutral. It means that liquidity is tight. It means the system is deleveraging. It means balance sheets are shrinking. Dealers are risk averse. Risk premiums are rising. What else? Credit is slowing. Collateral could be scarce, and in the future looks less risky than the present. This last point is the paradox. In an inversion, long-term money is cheaper than short-term money because today's financial conditions look worse than tomorrow's. That is the system calling for help. So, brings me to my next point, which is I think of the yield curve as a liquidity indicator. Think of the yield curve as a liquidity slope. So you have a steep curve. This is liquidity expansion, which means easier funding, higher valuations, and some risk appetite. A flat curve is uncertainty. This is, neutral funding and cautious risk taking, I would say. And then you have the inverted curve. This is liquidity stress, funding strains, rising defaults, and scary word, but recession risk. The curve tells you where the system feels pressure right now. This is why the yield curve is one of the most reliable indicators, you could say, of recessions, liquidity conditions, cycles in credit, compression in valuations, and stress showing up in markets. So tying how dealers shape the curve, because the yield curve is not just a prediction tool. It is the result of dealer balance sheets. And I'll give you an example. Dealers, how they shape and mold this, they arbitrage different points of the curve. They hedge duration exposure, trade swaps, price futures, make markets and treasuries, and fund their balance sheets in repo. So when dealers have room to expand, they flatten the curve. They keep pricing stable, and liquidity flows smoothly. But when dealers are balance sheet constrained, this is where the volatility starts to rise. You'll see the curves twist, if you will, the dislocations kind of forming. Long rates kind of decoupling, the curve signaling stress, basically. So I think this is a very important point when because we all look at the yield curve, I think, and interpreting it is or what it means is important. So how does this have to do with, or what does this have to do with valuation and the finance side, the finance view? So just to give you an idea, the valuation is powered by cash flows, growth, and discount rates, which we've talked about. The yield curve determines risk-free rates, inflation expectations, GDP expectations, equity risk premium, the directions that's going, credit spreads amongst some, and also cost of capital trends. That's a big one. So when the curve steepens, valuations generally expand. When it flattens or it starts to look inverted, valuations start to contract. This is the link between liquidity, discount rates, and valuation cycles, I would say. And so once you see the short end, funding in the Federal Reserve, in the long end with growth and inflation, the slope, the twist, dealer stress, if you will, in the inversion, the yield curve kind of stops being this mysterious object, I could say, but it can start to look more like a map, like a diagnostic tool, a forecast as well, and a liquidity thermometer. That's why this is, I would say, one of the most important episodes as we tie in finance and valuation, because this can really help paint a different picture. So once again, thanks for listening to episode 12 of the Global Ledger. Today we decoded the yield curve, and not as some mysterious thing, but as a living picture of the entire financial system. In episode 13, I think we're going to take the next step. I think we're going to talk about the euro dollar system, offshore dollars, onshore power. This is where it gets interesting. So once again, I am Justin, and thanks for being with me.